Japan is dumping US debt at the fastest level since 2022. If you own a home in America or you're trying to buy one, that number is about to show up on your mortgage payment because the single biggest foreign owner of US government debt is selling at a record pace. Meanwhile, the US 10-year Treasury yield, the interest rate Americans pay to borrow for 10 years, just hit 4.7%. The 30-year mortgage average from Freddie Mac has climbed 3 weeks straight to 6.58%. And the 5-year adjustable rate, the home loans that reset with the market, jumped over 40 basis points in a single week to 6.64%. Today, I want to walk you through 4 things. Why a rate decision in Tokyo affects your loan in the US, the $1 trillion trade that already blew up once and will likely blow up again, and why the Federal Reserve can't rescue us this time, and how all of this lines up with the 18-year US real estate cycle. If you find this useful, hit the like button and subscribe to the channel. So let's get into it. Most people think the Federal Reserve sets your mortgage rate, but the 30-year fixed mortgage is actually priced off the 10-year US Treasury bond, plus a spread the lender takes for risk. So when the 10-year yield goes up, your mortgage rate follows within days. And a bond yield goes up for one reason: there's not enough buyers. For years, the Federal Reserve was the buyer who stepped in, holding around 26% of all treasuries back in 2021. Today, that share is down to about 14%. The Fed stepped back, so private and foreign buyers now make up more of the buy side, which makes American interest rates more sensitive to foreign behavior than at any point in the last 20 years. And the biggest foreign buyer in the world is Japan. Japanese pension funds and life insurers have spent 3 decades buying US bonds because at home they earned nothing from low yields. That's about to change, and we're seeing it at the moment. March recorded the largest monthly inflow ever into funds holding Japan's own government bonds. Analysts tracking this reckon that if the pace holds, annual outflows from the US will surpass $100 billion. So, in plain English, if Japan keeps selling US treasuries, it can affect your mortgage rate. On a $400,000 loan, the difference between a 6.5% and a 7.5% yield is roughly $270 a month. That's over $3,200 a year for the same house, just because a pension fund in Tokyo rebalanced a spreadsheet. This is becoming more of a reality than ever before. So the obvious question is, why is Japan suddenly bringing its money home after 30 years of sending it out? Because Japan finally changed their monetary policy. The Bank of Japan's base interest rate is now 1% for the first time since 1995. For an entire generation, Japan was the country where money was free, and that free money got exported everywhere. That era just ended, and the 10-year Japanese government bond yield is sitting around, get this, 2.9%, a multi-decade high. The 2-year is at 1.5%. That's a 31-year high. And here's what it means for Japanese life insurers. They can now buy a domestic bond in their own currency with zero exchange rate risk and earn a real return. There's no need for them to keep funding American mortgages instead. So the selling pressure of US treasuries will continue and mortgage rates will keep rising. This is further supported by Japan's inflation problem. Japanese household inflation expectations just hit the highest level since records began in 2006, averaging 10.8% over the next 5 years, while wage growth is running at 5.3%. High inflation means they'll likely keep raising interest rates, which makes Japanese bonds more attractive and US treasuries less attractive. While this is happening, the Japanese Prime Minister has launched a 370 trillion yen investment program called Strong and Wealthy Japan. This will fund AI, semiconductors, quantum, energy, running out to 2040. Her government has abandoned the promise to get its debts under control, and Japan's debts sit at roughly 249% of its GDP, meaning the country owes nearly 2.5 times what its economy produces in a year. That's one of the highest in the world. Japan was the country the entire world regarded as the model of sound money, and it's now running an unfunded expansion with a collapsing currency and bond yields at 30-year highs. Does it sound familiar? The US experienced some pain from this in August 2024. It's called the yen carry trade. You may have heard about it. Everyone freaked out a couple of years ago. Here's how it works. You borrow money in Japan at close to zero. You convert those yen into US dollars. You buy something that pays more, US treasuries, US stocks, whatever the yield is higher on. You pocket the difference as a profit. Estimates put the total size of this trade somewhere between $10 and $20 trillion. If it breaks, it will have devastating effects on the global economy, but it's a free money strategy for as long as two things stay true. The rate gap stays wide. The gap between US yields and Japanese yields have already closed from 325 basis points earlier this year to 250 today. The yen stays weak. Short positions against the yen have hit $11.3 billion. That's a near 2-year high. A huge number of traders are still betting the yen keeps weakening. And that crowded short trade is exactly what makes an unwind likely, because when those traders are forced to buy the yen back, the currency spikes and the loan they took out in yen suddenly costs more to repay than they borrowed. We watched this happen less than 2 years ago. The Bank of Japan lifted rates from near 0 to 0.25%. Then the Nikkei, that's Japan's main stock index, suffered its worst single-day drop since 1987, and the Nasdaq lost over 13% in the following weeks. $200 billion of carry positions unwound in 2 to 3 weeks. That was only a 25 basis point move. The Bank of Japan is now at 1%, showing no signs of slowing down. So who's supposed to catch this falling knife? In every previous crisis, the answer was the Federal Reserve. This time, the Fed is the problem. Kevin Walsh was sworn in as the 17th Fed chair on the 22nd of May this year, nominated by President Trump. The assumption was that he'd cut rates to keep the White House happy. He's done the opposite. Walsh has been hawkish, meaning that he leans towards higher rates, and he stated the Fed has no tolerance for persistently elevated inflation. This is because US inflation is running at 3.5% annually as of June. The Fed is looking at inflation that refuses to fall due to an oil shock from the Iran war, and we've just seen that take off yet again. So the Fed isn't coming to save us this time, not again. If you're a homeowner, this should worry you, but not everyone is exposed in the same way. 92% of US home loans are fixed. If you're locked in at 3% in 2021, none of this touches your monthly payments at all. But when every homeowner is locked into a favorite mortgage rate, nobody wants to sell and give up a cheap loan, which strangles inventory for everyone trying to buy. So the pain concentrates on new buyers, on anyone with an adjustable rate, and on anyone forced to sell by life itself. Google searches for "can't sell my house" just hit an all-time high in March. The University of Michigan Consumer Sentiment Index fell to 44.8 in May. The average household is estimated to be losing over $1,200 a year to the combination of fuel, groceries, and borrowing costs. Then there's the builders. XHB, a fund holding America's big home builder stocks, dropped roughly 20% in the first quarter from its February high, and builders are leaning harder and harder on rate buydowns to get houses sold. A buydown is where the builder pays cash to lower your mortgage rate, so it's a hidden price cut. The price tag holds while the builder's profit shrinks. So we have Japan selling US Treasuries, Iran war keeping US inflation high, a Fed chair who has to keep interest rates high, and builders throwing in a free rate buydown, all of which increase US Treasury yields, which increase US mortgage rates. They only click into place when you see the pattern running underneath them. Real estate moves in a rhythm of roughly 18 years. It's 14 years up, then about 4 years down. Fred Harrison mapped this out in the UK, and Phil Anderson refined it using US land sale data going back over 2 centuries. That framework is what led Harrison to call the 2008 crash years before it arrived. And the last major US housing bottom was around 2011 to 2012. So we count up 14 years and we get to around 2026. The final stretch of the boom that we've been seeing and in is called the winner's curse phase. It's the phase where the last buyers pay the highest price with the thinnest deposits at the single worst moment in the cycle. Today, credit is being pulled out of the system by a foreign central bank raising rates for the first time in a generation. The buyer of last resort for the US debt, the Fed, has cut its holdings from 26% to 14%, and its new chair has no interest in stepping back in to buy up these bonds. And the builders, the group that always mark the property market top first, have been making lower highs since February, and actually lower highs since 2024. Every cycle peak in history had a similar setup to what we're seeing today. On the flip side, there's a genuine case that none of this breaks. Most analysts still describe the Japanese selling as an orderly portfolio rotation. Orderly rotations can run for years without anything snapping, or we could get short-term warnings like 2024 unwind which recover quickly. 92% fixed rate mortgages is also a real cushion, and it's the reason American households are far better protected now than they were in 2006. Add the Supreme Court reinforced Fed independence on its 2026 opinions, which reduces the risk of political interference blowing up the bond market from the American side. So what we're saying is tops are a process. They take time. I'd rather be prepared and a bit early than caught out on the long-term cycle completely. Every signal is pointing the same way. Signal 1, Japan sold nearly $30 billion of US bonds in a single quarter. That's the biggest reduction since 2022, and the pace isn't slowing. Signal 2, the yen carry trade, somewhere between 10 to 20 trillion in size, is under pressure as the rate gap narrows to around 250 basis points. Signal 3, the Fed underwash has 9 of 18 policymakers penciling in hikes rather than cuts, and even split on the dot plot and market pricing leaning towards higher rates by year end. 3 separate forces are all pushing the 10-year Treasury yield in the same direction. So if you own your own home and your repayments are comfortable on a fixed rate, don't panic sell. You're in the best position of anyone watching this. But don't build your plans around a refinance at 5% arriving next year, because the entire structure we just walked through argues the other way. Run the numbers on how long you'd need to stay put for your cheap loan to remain the right decision. If you bought in the last 2 years near the top, or you're on an adjustable rate, this is the moment to take action. Stress test your budget against 8% rather than today's 6.5%, and work out what that does to your monthly number. If it frightens you, start setting the difference aside now every month into a safety net. Ideally 3 to 6 months of repayments in cash. Do this ASAP, or you could find yourself in a world of pain. If you're sitting on cash waiting to buy, be patient. You are watching a market where sellers are stuck, builders are discounting, and foreclosures are up 21%. Every part of that improves your position. But don't catch a falling knife on the first bounce, because buying at the wrong point in this window can cost you years just to reach break even. I also recommend you go to open homes now. Talk to agents, learn your local pricing, and build the relationships, because there are cycles within cycles, and the area you're looking at may be in a slightly different position. Could be slightly ahead of where we are now, or possibly slightly behind. And if you're an investor carrying leverage, obviously be careful right now. The cheap global funding that refinanced risk assets for 30 years was manufactured in Tokyo, and Tokyo has turned off that tap. The 3 things I'd watch from here. Watch the 10-year Treasury yield, and specifically whether it holds above 4.7%. Watch the Bank of Japan's guidance out of the July 30th and 31st meetings, because the language matters more now than the decision itself. And watch XHB, that's the home builders ETF, for whether it crashes or breaks upward. Apply the same lens locally too. Check your own market's days on market and how many listings are carrying price cuts. Those numbers will tell you whether we're right, early, or wrong. Now I want to hear from you. Where does this all resolve? Does Japan's selling stay an orderly rotation that the US bond market absorbs without much drama, letting mortgage rates drift back down through 2027? Or does the carry trade unwind properly like it did in 2024, blowing the 10-year yield out and dragging mortgage rates towards 8%? And which one cracks first, the Japanese bond market or the US housing market? Drop your call in the comment section. As I have done with the previous videos, I'll read every single one and replying to as many as I can. If this video helps you connect Tokyo to your mortgage payment, hit the like button and subscribe to the channel. I cover charts, stocks, commodities, and Bitcoin over on my other channel, Jason Pizzino. There's a link to that in the video description. We'll dig into the private credit side of this whole dilemma in a future video. But until next time, I'll see you guys at the next video. Take care and peace out.